but we're going to be talking about building real estate, building real lasting wealth today. So we're going to talk about how to actually use multifamily to build some serious wealth for you and your family. And again, I'm going to turn off the video so y'all can see this full slides. Cool. So number one, we have recession resistant. So people always need a place to live, no matter what the economic landscape is. So that's something that's not going to go anywhere. And that's kind of why it's recession resistant. And there's some stats to back that up, right? So we actually had less than a 1% default rate in 2008 for multifamily. In 2008, for those of you who lived under a rock for those years, it actually was one of the worst times in our economy's history. And for multifamily to be 0.4% default rate is pretty great. And the main reason for that is because there's multiple streams of income. So if one tenant's not paying, or if one unit is temporarily empty, then the overall units are probably still going to be profitable. Because we can lose a tenant, we can lose 2 tenants. If we have 100 tenants, we still got 98 other people. And the benefit there is, you can afford to lose people. The thing that happens quite a bit is you have circumstances come up in recessions where people lose their jobs, they can't pay rent. But the thing is, if you have 100 of them, it doesn't really matter if people lose their job because you have so many, your risk is so diversified. So that's kind of the benefit of having large multifamily is you get that diversified risk and therefore it's recession resistant. So we also have an overall demographic shift to a renter culture. So home ownership is no longer the American dream. And this is something that's really important to understand. There's a lot of different drivers for this, but number one would be people don't really want the white picket fence anymore, the home, the family. You get out of school and you get married immediately and you have kids immediately and you guys buy a house. That's kind of what the baby boomers did, but millennials aren't really into that. And that's statistically proven here with the fact that there's been a 134% decrease in the number of renter households, increase in the number of renter households from 2004 to 2019. I apologize, it's a typo. But yeah, there's been a 134% increase in the number of renter households from 2004 to 2019. So quite a few more people are renting now. And number two would be the more traditional homeownership households, married families with kids, that's dropped from 41% of all households to 19. So the whole thing about marriage and kids and the whole classic, 2 kids and you live in the suburbs, that's kind of gone because number one, women have so many opportunities in the workplace now that they're able to actually test their skills in the marketplace and be rewarded for an extended period of time. So they forego having children earlier in life so that they can contribute to the workplace, and they're having the ability to do so in modern society. So there's a lot of different drivers causing this, but homeownership is definitely on the decline. So if we can own the place where everyone rents, that's going to be very beneficial for us in the long term. So we also have economies of scale. And to put this simply, it's buying in bulk, right? When you go to Costco, you end up paying less per unit because you're buying such a large quantity. And that's the same concept in multifamily. Basically, it's going to be a lot less expensive to build, operate, and maintain larger properties just because of the economies of scale. And the other benefit of this is that scale is going to allow you to hire full-time management. So you're going to have so much extra income that you can actually employ people on payroll to do all of the operations so that you can be anywhere in the world and run your property. I currently own properties in Louisville and Atlanta, and I'm located in Austin, Texas. It takes me about an hour a week to oversee the management process, and that's about all the time that I have to put into those properties because of the scale. Now, if I owned a single family house in Atlanta or Louisville, I'd be there, almost once a month in person trying to make sure everything went well. And it might maybe even be more than that. I might not even be able to do the long distance. I might have to have like a turnkey company do it for me, and then the margins are completely killed. So that's the benefit of scale and the size of multifamily. The other thing is passive income. So you receive income from tenant rents, right? So it's basically the people need a place to live and you're receiving income as a result of that. And that's coming in no matter what you do. And because of that economies of scale we just mentioned, even if you're an active investor, you have free time and you get to enjoy your life. And that's the real benefit, is the fact that it's an asset that you're going to be receiving passive income in, so you don't have to be trading your time for money anymore. You can make money every single month because people are going to be paying rents on the first of the month, regardless of what you do, right? Your management company's taking care of it. You have all the scales in place, and basically you're receiving passive income, and you're able to enjoy your life, which is what it's really all about. This is the other big benefit here, which is control. So cash flow is from a real asset, a real building that you can go and touch and feel. It's not on the screen. It's not a computer-based thing. It's not a stock on a screen or a number on a screen. It is a real building that you can go and see, touch, and walk in and live in. So it's a real physical asset. Number two, people always need a place to live. That's not going anywhere. Some things can get replaced by technology, but having a place to live is never going anywhere. And third is the actual way that commercial real estate is valued. So the way that multifamily and commercial real estate is valued is not based on comps. So it's not based on how cute your cabinets are, or your countertops, or your floors. It has nothing to do with that. It has everything to do with your basically your profit. So it's the NOI, or the profit, divided by the cap rate, and that's what's going to equal your purchase price. So here's a really simple example here at the bottom that we'll walk through. So let's say you have a 50-unit apartment, and it has an NOI of $100,000, and the cap rate is 5%. So a cap rate is basically the market evaluation of both risk and also value of property. So what people agree to pay for a certain asset in a certain market is basically the cap rate, put simply. And so we can't necessarily control that, but if we can look for a market that has a relatively stable historical cap rate, then we know that that's going to stay somewhat the same. That means that we can actually increase the profit and raise quite a bit of value here because of this formula. So the formula is going to yield this $2 million purchase price on the front end, right? Because 100,000 divided by 0.05 equals 2 million. But we're going to actually increase that NOI here in this example by increasing the rent $100 per door, which is a pretty simple task, right? It's just $100 per door, not a huge deal. So you have 50 units, timesing it by $100 times 12 months. That's going to raise your profit, or your NOI, $60,000. And $60,000 doesn't seem like a big deal. It seems like kind of a small number. But when you look at this formula right here, which is, this is still the same 50-unit building, but now it has an extra 60 grand of NOI. So it's no longer a $100,000 NOI property, it's 160,000. And so we take 160,000, divide that by 0.05, and our new price is 3.2 million. So this little $100 per door change is going to yield us $1.2 million in profit on that one simple thing. So that's the power, right? It's not about anything like, oh, I have to buy in the neighborhood and my neighbor has to have a nice house as well, and we have to go on comps, and then I have to get these cute countertops that I saw on Instagram. It's not like the whole flipping thing in single family. It's about business, it's about numbers, it's about profit increase, and that's something that you can control, and that's nice. Yeah, love forced depreciation. Exactly. Yeah, that's exactly what another word for it there, Gregory, which is forced depreciation. So you're literally forcing that appreciation. You don't have to cross your fingers and hope for it. So proven, this is another great thing. So the question that I would ask you guys is, what has made more millionaires than all other industries combined? And I encourage everyone here to take a wild guess at this in the chat right now and just see what happens. So what do you guys think is the industry that's created more millionaires than all other industries combined? Real estate. Yeah, you guessed it, Gregory. Yep, Miguel as well, real estate. Yes, you are correct. Let's show you the answer. The answer is real estate by a long shot. And so here's some proof, because you may not believe me, right? I'm just a guy. But here's Andrew Carnegie. He's owned a lot more real estate than anyone in the skull, maybe that will ever own, which is awesome. So good for him. But this is a quote that he has about real estate. 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all other industrial investments combined. And then he even goes on here to give you some advice, right? The wise young man or wage earner of today invests his money in real estate. So that's from Andrew Carnegie, right? If this guy is talking about it, I think it might be a decent thing to at least look into, you know? So now we've kind of decided, okay, we're going to give this multifamily thing a shot. Well, now why B and C class within multifamily? So why do we specifically choose to invest in the B and C class assets within multifamily? The first thing is the lack of supply and very, very high demand. So basically, if you see here from the graph, the blue lines are the A-class buildings being built. So people are only building A-class. And the reason for that is you can't actually afford to build a B and C class property because it's not going to yield enough income to justify the replacement cost. So if it costs me $135,000 to build one unit, I need to be building an A-class unit because that A-class unit is going to get A-class rent. So it's too expensive to build B and C class properties. So therefore, people aren't building anymore. So the supply is cut off. And I'm going to show you here why the demand is so high. So B class is insulated because of that cost of building. And so the great thing is the demand is super high because A-class apartments are only affordable for 20% of wage earners. You kind of have to be in that upper echelon of wage earners to be in an A-class apartment. The rest of the whole population needs B and C class affordable housing, and they are not building any more of it. So the supply is choked off, and the demand continues to rise as the income gap continues to grow. So it's essentially, we're in a great situation where supply is not coming anytime soon, and demand is going higher and higher every year. So it's a really good opportunity to be in B and C class. And on top of that, we have more stable occupancy rates. So you'll see here, the blue line being A class, you can see where the occupancy is hovering, and it's starting to drop pretty drastically because the affordability is just not there. And you know, they're building so many that the supply becomes overdone, and then there comes a point where there's so much supply they can't be picky. They start offering concessions and they're kind of fighting against each other. Whereas we can be more picky with tenants because we have such a high demand. So we can see here, we're pretty much always going to be occupied above 94 because of the fact that we have so much demand that we're pretty much, spoiled for tenants in some sense. But then also that gap I was talking about is continuing to increase. As you can see, the difference between A-class rent and B-class rent is $500 basically. So it's just getting it's just getting like less and less affordable for people to live A-class, and there's more and more people who need B-class, and there's less and less B-class available. So it becomes an amazing opportunity to invest in B-class because everyone's scrambling to try to live there, and they're not building any more of them, and that puts you just in a really good position. So that's pretty clear. Let's do B and C class, right? Sounds like the good move. But now, why multifamily over the stock market? I've heard some awesome things about the stock market. Why don't I just focus all my time there? Well, let's talk about leverage number one. So multifamily, I can leverage up to 70 to 80% of the cost of the asset and still reap 100% of the benefit of the asset. That's the best part, right? Stocks, you can do some stuff with margin, but it's capped at about 50%. And real estate, sometimes I can even do more than 70 to 80%. Sometimes I can even get 100% if it's a construction loan. You can do a lot of different things with real estate leverage. So you're able to have a lot more purchasing power, and you're able to actually utilize 100% of the benefits. Whether that's tax benefits or income benefits, you're still able to utilize 100%, and you're only having to put down 20 to 30, which is a pretty awesome trade. And not only is that leverage available, it's also very good leverage in multifamily. So it's non-recourse leverage when you're using agency debt. And so what non-recourse means is basically that I am the borrower, right? And I'm not personally held liable beyond the actual debt or collateral that I have on this specific loan. So if I buy a multifamily unit, let's say a 50-unit multifamily building, and I default on it, worst case, I end up in that very small 0.4% of people who lose their property. Well, the bank's only going to be able to take that specific property. They can't touch any of my other assets. They can't touch my personal property. All they do is take the collateral for that loan, which is the building itself. So if you're an investor and you have 5 businesses on the side and you want to buy one 50-unit property and something really horrible happens, you end up being in the 0.4% of people who lose it. They're only going to take that specific 50 unit. They're not going to take your other 5 businesses. They don't do that with non-recourse. And the other added benefit is, let's say you buy that 50 unit, and then 6 months later you want to go buy a personal residence. Well, guess what? It's not going to show up on your personal financial statement as a liability. So when you're going to get that new loan for your primary residence, it's not going to show up that you have some massive loan out against you as a liability. It's only going to show up that you own a lot more real estate now as an asset. So that's a huge benefit of non-recourse there. And again, feel free to ask questions in the chat or in the Q&A boxes during the thing. I'd love to interact with you guys if possible. And then we're also going to have a Q&A at the end, but it's always fun to do it during the middle as well. So we have the stock market versus multifamily as far as returns. So the average annual return for the stock market since 1950 is around 7%. And I was pretty generous with the stat. Like I found a lot more worse stats. I could have said this was 5%. There's several sources that were pretty keen on 5%. And I decided to be a little bit generous because I didn't want to hear any of the other stuff. Like I could factor in fees and inflation and bring this down closer to 5, which is what a lot of people do. But I'll just leave it at 7 because I want to be nice. And so the benchmark of most average annual returns for multifamily, or at least the ones that I'm doing, are around 20%. And I'd say that that's pretty standard across the industry, which is the average annual return you're looking for is going to be around 20%. And that's not counting the tax savings that real estate gives you against all your other income. And we're going to talk about those tax savings here in a second. So not only is the returns better, but that's not even factoring the taxes, which we're going to talk about here, and the stock market. When you're selling stocks, you're going to pay 100% of long-term or short-term capital gains. So short-term is when you hold it for less than a year, and you're going to pay capital gains tax based on your ordinary income bracket. And if you have a long-term game, you're going to pay approximately 15% tax. So you're going to be paying taxes on any capital gains in stocks. But multifamily, we're actually not going to need to do that. We can defer it through a 1031 exchange, which we're going to talk about here. So when I sell something in real estate, if I buy more real estate with the real estate that I sold, the profits from that sale, then I'm able to actually defer the capital gains. So I'm not going to be paying taxes on that. I'm going to kick the can down the road, and I can do that until death. So you essentially don't need to be paying taxes or you can be deferring your taxes, I guess would be the proper legal term there, on your profits from sale. And then also, we have depreciation against the profits during the hold. So even while we're holding this thing, we should actually be able to offset a lot of our earned income, and that's going to be an amazing thing to do. So let's say my question may be an end question, but what do you think about Canadian real estate? Because I contacted a successful real estate investor of my area, and he said that the average cash flow for an apartment complex is $50 to $70. So what do you think? Well, I'm assuming that he's saying per door, the average cash flow is around 50 to 70, and that's not too bad. Typically in the markets that I'm in, it's around 100 to 150. So that seems like it may be a little bit hard pressed for cash flow, but I don't think he's saying that the whole complex is only going to give you 50 to 70 bucks a month. I think he's saying per door, you're going to be making 50 to 70 a month, which is actually not too bad, especially if you, let's say, have 100 doors, then that becomes a pretty decent number. So thank you for the question, Miguel. Let's get into depreciation. So the current value of the property is $1 million. So basically what we're going to be able to do here is the IRS says that your property is going to become fully depreciated in 27 and a half years. So we can divide our value by 27 and a half and we get our annual write-off. So here's $36,000 that we get to write off against our tax liability for the fiscal year, every single year. And this is just basic depreciation. So if anyone here paid more than $36,000 in taxes last year, how would you like to not do that? You know, that's the kind of awesome thing with multifamily and also real estate in general, but predominantly multifamily. And for the reason that we're going to talk about next, which is cost segregation. Because in cost segregation, this really only makes sense to run a cost segregation study if you're going to save a significant amount of taxes. And the only way you save a significant amount of taxes on cost seg is by having a lot of property or a lot of scale. And so that's why multifamily is a good situation. So basically all that cost segregation is that $1 million value we just talked about, we're basically going to argue here that that value doesn't come just from the structure. It also comes from these two categories as well, meaning the land improvement. So the improvement we do to the land, we're arguing that some of the value comes from that. And also we're arguing that some of the value of that building comes from the personal property as well, which is totally fair, right? Appliances, cabinets. And so these are the two categories. Land is 15 years, land improvement is 15 years, and personal property is 5. So essentially, we can separate about 30% of that $1 million and claim it as being comprised of these two categories, land improvement and personal property. So that 30% is 300 grand. So we can take that 300 grand and put it into these two categories respectively. So same $1 million property, but now we're doing a cost seg study. And so we've deemed 20% of the building's value comes from personal property, which as you remember is on a 5-year scale. So we take that 20% of 1 million, 200 grand, we divide that by 5. Now we're already at 40,000, which is above 36, and we are only 20% way through here. So that's pretty awesome because if we just leave it at regular depreciation, we're stuck at 36,000 annually, but now we're already up to 40,000 annually, and we're only at 20% of the property's value. So now we still have 10% here in land improvement, divide that by 15, we get an extra 6,600. So now we're 10,000 over the other one, and we're only 30% through. Then we get the remaining 70% on the regular schedule, and that's going to give us an extra 25,000. So now we've doubled our annual write-off. So now you can write off 72,000 against any taxes that you owe annually, which is pretty awesome. So not only are you making all those returns that we talked about, you know, the 20% average annual return, you're also going to be able to save all of the tax money that you're usually paying. So let's say you're like a doctor, right? And you're making 200 grand a year and you're paying somewhere around 50,000 a year in taxes. You're just losing that part of your income. Well, now not only are you going to make 20% annually on the investment that you give to the real estate or that you put into real estate, but you're also going to save all of your tax liability because you can write off 72,000. That actually leaves you with a $12,000 loss for the year. So you're actually going to be able to make the 200 grand that you are actually being paid. You're not going to have to lose 50,000 of it anymore, which is a completely huge added benefit that's not factored in to the returns. So that's pretty sweet. But let's talk about inflation. So rents keep pace with inflation historically, as you can see here. Since 1965, it's been well over. But also, let's say that hyperinflation happens and that it doesn't keep up with rent and somehow it just blasts through it. Like we have like a South American Venezuela kind of hyperinflation where $1 million only gets you a cheeseburger for something crazy like that. And that's kind of what we're saying here. And what would happen would be your mortgage would actually stay the same dollar amount. So in that really crazy, very rare or unique scenario, we would actually just be able to pay our mortgage off quicker because the dollar amount would stay the same, but the dollar would become so valueless that mortgage would be paid off very quickly. So Stella asks, what happened to those write-offs after I sold the multifamily? So there's a recapture that happens to those write-offs, but if you do a 1031, which is the thing we talked about with sale, so you sell that real estate, Stella, and you buy more real estate with it, then you're able to defer the recapture as well. So you're deferring all of the taxes. and eventually there will be a massive recapture. But if you keep kicking the can down the road until you die, then there isn't going to be that recapture, right? So that's something to think about. And it actually gets reassessed at your death, so your kids won't have to worry too much about the recapture either, because it'll get reassessed. So you can keep kicking down all of those defers down the road, and then never pay them. So that's a pretty sweet situation. Does the recapture come into play, Brandon, after you pass away? Brandon, so yeah, like I said, it gets reassessed on your death. So it basically is just on the current present value of your portfolio, and they kind of let all the recapture go, which is, have you heard of deferred tax sales trust? Gregory. No, but by the name, I can assume that it's some way of deferring your sales and maybe placing it in a land trust so that you would not have to do the 1031 exchange and still be able to defer taxes. Am I correct on that, Gregory? Something like that. Yeah, that's pretty fair. So Tim, with the 1031 exchange, is it possible to get money tax-free into the next deal? Yes. So it's absolutely, that's the whole point of the 1031, is to, let's say you sell a property for $1 million profit. Well, then you go and use that $1 million immediately to do a down payment on a $4 million property, 25% down. And I think that's exactly how you would use a 1031. So how can you invest? Or you can invest with an IRA as well in the stock market, in real estate, I apologize. So basically, a lot of people tell me, but all my money's already stuck in the stock market in my IRA, so what do I do? Well, the thing is, you can actually self-direct your IRA through a custodian, and basically then it allows you to invest passively in real estate syndications. So if someone's running a real estate syndication, you can be a passive investor in it, because the IRA, basically, it stipulates you can't be an active investor in it, but you can be a passive one, right? So you can be a passive investor in real assets like real estate. So that's something that you can definitely do. So my kind of thing is, you don't have to fully jump ship if you're into the stock market or you have a bunch of money in an IRA, but there's absolutely no reason to not at least diversify into real estate. So can you use 1031s as an LP in a syndication? Tim, I love that question. I appreciate you for asking it. So basically, yes, you can. You can 1031 into a syndication through a thing called a tenant in common agreement, or TIC. And so basically what's happening is you are claiming on the deed at the same time as the people in the syndication. So the GP are on the deed, and you as a 1031 LP are also on the deed in the tenant in common agreement. And so that you're actually able to use your same LLC and have actual deed rights, and you're able to do the like-kind exchange that way. But you can't do it just you can't just flat out go into a syndication, because you have to stay on the title of both properties. So it has to be a tenant in common agreement with the actual GP of the syndication. But you can still make it happen, Tim. So the key points of the presentation: passive income, which means owning your time; stocks versus multifamily and the benefits of multifamily; tax benefits; the demographic shifts that are happening right now and will continue to happen; and then the lack of supply with absolutely massive demand in B and C class. So now we can get into the Q&A, and also let me answer this question from Vinky real quick. What is the overhead cost for self-directed IRA? Also, do you pay taxes on profit? So great questions. It depends on the syndication. So if you are 1031ing with the syndication as a whole, so the whole syndication stays together and 1031s, then you can defer that profit as well. Or you can do something called a swap and drop, or a drop and swap. And that's a pretty ridiculous thing to say, but if you break it down, it's actually quite simple. And that is that in the swap and drop situation, if you were in your IRA invested in an LP syndication, essentially, let me turn my video back on too. So basically, if you were in an LP in a syndication and they decided to sell, what you could do is a swap and drop first. So not everyone wants to stay in, but you want to sell the property, but you want to do the 1031. So the GP does the 1031 exchange, and they swap into a new deal. And when they swap into a new deal, they do a quick claim deed, and they pay out all the investors who don't want to stay. And those people pay taxes, but the actual LLC stays intact and continues to defer the taxes. So hopefully you're in a situation where everyone wants to just 1031 and it becomes simple, and the whole syndication stays together and buys a new property. But if some people don't want to, you can do a swap and then drop the people, or you can drop the people first with quick claim deeds and then swap into a new property and hold the LLC. So you can make that happen. I hope that helps. Then Gregory, you're a wealth of knowledge. Thank you. Appreciate it so much, Gregory. Appreciate you, man. So what is the cost? Oh yeah, sorry I didn't answer that part of your question. So it's actually not too much money. I believe it's less than $500, and there's several different custodians that you can use. I believe it's somewhere around 200 if I'm completely honest, but don't quote me on that. It's somewhere around there. So yeah, it's not that much money. You'd be surprised. So before I answer any more questions, I do want to tell Adam to put the link to the deal analyzer and the pitch deck in the chat box. So we're going to give you guys a free download here of my deal analyzer. So I have one that allows you to essentially analyze any real estate deal and see your worst case scenario right next to your best case scenario. It lets you see your break even occupancy, so what your occupancy can fall to and still pay the bank. It also allows you to see your exact returns, and it allows you to see your GP returns as well as your LP returns, and all of the, basically anything under the sun that you could ever want, right? It even shows you your loan breakdown, principal and interest, in the switch to that. So if you're super interested and you want to nerd out, that deal analyzer is right there in the chat. Adam just put the link, and that's totally free. All you got to do is click and download it. And then the pitch deck is the, and well timed, Adam, well timed. So the pitch deck is basically my presentation to investors, so that I can, I raise capital from people, and I use a really specific pitch deck that I'm actually giving to you guys. It's the same one that I use, and it has like little brackets to put your own information in. So that, again, is totally free, and it'll help you guys start to raise money and do your own deals, because that's the whole point, right? I don't want to just tell you why real estate's awesome. I also want to give you some actual tangible stuff so that you can go out and start doing real estate deals. And then lastly, we want to give you guys a free 30-minute strategy call with me. So if you guys, analyzers and no pre-avail available, owner's trash. Okay, well, we'll fix that, and we'll either fix it now or we'll send it in the email tomorrow for sure, Gregory. So I apologize about that. But essentially, the strategy session, if you click the free call link, then we can talk for 30 minutes just about your personal situation, and we can try to see how we can get you moved to the next stage of your development. And hopefully we can give you the analyzer in that free call thing if it doesn't work as well. So if you're having a hard time with the analyzer, then you sign up for the free call, and I'll make sure you get it. And also we'll send it in an email tomorrow, worst case, if it doesn't work out right now. But for now, I'm going to get back to questions, and I'm sure Adam will fix the deal analyzer link, and also the pitch deck. I hope that works, and the free call. So if you want to sign up to talk to me for 30 minutes, I can give you as much personal information as I absolutely possibly can. So Stella, what is my number to call? Well, if you see that link, it says kylemarcotte.net/free call. If you click on that, it'll allow you to sign up for one, and you can put in my calendar and your calendar exactly which time you want to schedule for. And then we we set aside the time, and we talk about your personal questions in super big detail. So let's go through some of the Q&As so that we can help some people out. And yeah, let's see. So Jeff asks, when it came to buying your multifamily unit, did you have cash reserves? Did you go to a property that did not need any work? So Jeff, I went to a property that needed some work for sure. I'm not a big fan of like a very heavy lift where I have to do structural improvements, because I don't have a background in structural improvements, and also those don't make you any money. So the tenants aren't going to pay more rent because you added new plumbing, and they're not going to pay more rent because you fixed the foundation. They're only going to pay more rent for things that improve their quality of life visually and that they can experience. So new countertops, new stoves, new floors, that will raise rents. But new plumbing, no one cares, and it won't raise you any rent, so it just costs you money. So I try not to do those. And then, did I have any cash reserves? Absolutely. The bank requires cash reserves in order for you to close, because it's risky just to not have reserves. And typically it's around $350 a door per month or per year. But the other thing is, right now the reserve requirements on banks are extremely high because people are all very concerned about coronavirus and the impact on the economy. So right now banks are requiring 12 months of mortgage and principal and interest payments in reserves, not including the ones you're going to pay in year one. So you have to have a whole year of payments in reserves, because the bank is pretty hesitant to lend out right now because of coronavirus. So that's something to really consider if you're thinking about moving into multi-unit now. The reserve requirements are rather high, and I hope that everyone can infer what that means as far as a risk standpoint and a market cycle standpoint as well. So people who are saying that this is not a big deal and all that good stuff, it kind of might be. So who knows? But reserve of the rent that you reserve. I'm not 100% sure about the wording there, but basically what I'm saying is that you have to reserve some of the rent that I collect, yes, of course, so that just in case, a rainy day happens, to put it in common English, would be if my AC units all break, I need to have some sort of reserve. Otherwise, what's going to happen? People are just not going to have AC for a couple months, which would not be ideal. And then also, sometimes you'll have to bring extra reserves to the actual deal itself in the form of your tax payments and also your mortgage payments, so that the bank feels comfortable lending to you. So you'll have to raise extra capital to actually bring that money and put it in a reserve account immediately. So those are two ways to have reserves. Miguel says, will you make another presentation about how to buy a multifamily property and stuff like that? So Miguel, yeah, I have one on how to analyze one and how to find one. They're up on YouTube right now if you want to watch the replay. And I'm sure Adam will put a link to the YouTube channel at some point, which will for sure be a good resource. But also we're going to be doing a couple more of these. I think we have 5 more over the next 5 weeks. And I'm sure we're going to talk about some really cool stuff like that too. So just keep watching your email. I am 15 years old. Could you still have, yeah, dude, more, actually, you can have the call before anyone else, man. 15 years old. Miguel, sign up, man. I would love to talk to you. How are you 15 and on a very niche multifamily webinar, man? That's absolutely insane. I'm really happy you're here. And you've asked like 4 questions and you're 15. Dude, please get a call. I would love to talk to you, man. That's absolutely astounding. I can't even believe that. You just made everyone here feel very guilty. 15 years old. Dude, that's amazing. Good for you, dude. That's so cool. I thought I was a young guy. I was always like, oh, I'm the young guy. Dude, the 15-year-old, dude, that's amazing. So I think that the new deal analyzer link is probably going to work. And then here's also the YouTube channel. Adam's put that in there. So go and try the new link. If it doesn't work, let me know. I think it should. And then the YouTube channel here. And yeah, feel free to continue to ask questions. I'm going to be here for a little bit. Let's see. So we have Jake. Jake said, you discussed your portfolio being reassessed upon passing. Would your family be at risk of losing portions of your portfolio that you had left them? Also, with the 1031, is this something that you have to tell a CPA, or do you do this for, yeah. So the 1031 exchange is, you absolutely need a professional there, because the actual legal ramifications of a 1031 exchange is that you have a qualified intermediary. So what that means is that you can't actually touch the money. So if I sell a property and then the money passes through my bank account, it's disqualified. I can't use it. So what I have to do is sell the property, and immediately that money goes to a qualified intermediary who is a third-party person not associated, and it doesn't touch me. And then I have to tell that qualified intermediary I have to identify 3 properties in 45 days, and I have to close on one in a certain amount of time as well. So there's a time constraint there in order to do the 1031. So you have to sell the property, give the money to a QI or qualified intermediary, and then identify properties you would want to buy, and then you have to buy one of those in a time frame, and that's how the actual 1031 happens. So you definitely do need to get some sort of professional there. There's a lot of different QI firms out there. I actually had one on my podcast. 120 days. I think it's 145. Man, I could be wrong on that, but I could be wrong. Yeah, and also there's extensions that happen sometimes to the IRS, like for 180, I believe sounds right. I apologize. The reason I'm so confused on that is because we actually just got an extension for ours from coronavirus, so it's all over the place in my mind, and I apologize. And I don't want to say the wrong date, so I'm pretty sure it's somewhere around 180 to 120 in that gap. But we've just gotten an extension, so my mind's a little squirrely on that. But there is a time limit that you need to be wary of, Jake. That's just all you need to know at the moment. You can always Google that. Let's see. So Jeff, does the property management help with finding and vetting construction workers to fix your property? Also, do you use the same property manager for every property you acquire? So that depends on the market that I acquired the property in, because property management companies are typically not nationwide. They're more local. So I'll vary. Like I have a property in Louisville that has a property management company there, and then one in Atlanta that has a different one. As far as vetting, yes, absolutely. That's their main job. Yeah, thank you, Rodney. It is. You're correct. That sounds pretty accurate. Actually, no, that's correct. 180. So Jeff, yeah, back to your question. Finding the construction workers, absolutely. That's the main part of their job. That's why they're getting the fees associated with their property management company. But you want to ask for 3 different quotes, and you want to verify that those quotes are real people that they've actually went and talked to before you pick one. And that's usually for anything that's over around $500. So if it's a bigger expense that's going to cost you some money, and you know that it needs to be done, like let's say a roof, you would want to tell your PM, hey, go get me 3 roofers to quote us on this repair. And then you go and look at the roof repair. And if it's from Bobby's roof repairing company, you want to call that guy and be like, hey, did my property management company reach out to you? And if he's like, no, then be like, okay, well, they've obviously just going to pick the one and do some stuff under the table. So you want to verify that they're real. And then you also want to get at least like 3 of them so you can pick the best one. So Tim, what brought you to your different locations with investment properties? That's another great question. So Louisville for me was my first ever deal. I was 20 years old and I had just dropped out of school. I had absolutely no money. I had raised all the capital, and it was 107 units. So it was a $4.5 million property. And I basically just wanted to make sure that the location wasn't going to go and take a dive, right? So I picked one of the most stable locations in the country, which is Louisville, right? It's a very middle of the country, linear growth city. Through 2008 through 2000, we have a very linear slope here. So it's just continuing going like that. I don't have to worry about these big peaks and troughs. And I didn't want to worry about that. I wasn't going for the home run. I was making sure that people's money was safe because it was my first deal. And to be completely honest with you, you don't really know what you're doing on your first deal. You think you do, and you do your best to prepare. But so much stuff comes up that you could have never, ever known. And yeah, so I just wanted to make sure the location was at least going to be stable. And so that's why I picked Louisville. Jake, could you cover the first part of my question too regarding the family? Okay, yeah, sorry about that, Jake. So the other part of the question would be your family being at risk. As far as being at risk of like losing a property, no, not at all. The thing is, the value of the portfolio is reassessed. So that would indicate the taxes upon that value. It has nothing to do with them like saying, oh, we're going to reassess if you own this or not. Ideally, what you do is you leave it in a trust and you have that trust be going to your heirs. So that's a very simple transaction and there's no probate. But the thing that the reassessment is just about the value so that you don't have to, so that the taxes are now reassessed because they're not taking into account that huge snowball that you've been piling up for, let's say, 40 years, right? They're only reassessing the death day value as that being taxable. So no, it doesn't put your family at risk. In fact, it's probably the best thing you could ever do for your family. So I hope that answers that. Got it. Appreciate it. Awesome. So Trisha, what resources do you recommend? Maybe a book if you are very new to this and want to get a handle on all the terminology and moving parts of doing this. So yeah, there's a lot of terminology, Trisha, and I'm actually working on putting together a dictionary for just all the terminology that I'm gonna give out at some point. So I'll let you know whenever that happens. But right now, as far as books, I mean, have you read Rich Dad Poor Dad? Because I think that's probably the best way to start. And if not, then I would say read Crushing It in Apartments. If you've already read Rich Dad Poor Dad and you want to be a little bit farther ahead, I would say Crushing It in Apartments by Brian Murray. He puts apartments in a very simple way. The Crushing in Apartments isn't gonna like necessarily make you take it to the stratosphere, but if you're still confused about the lingo and you want it to be not intimidating, then he puts it in, he does a very great job of making it accessible. He doesn't do the whole thing where he tries to be over the top, like analytical and confuse you. He just gives it to you simple, gives it to you straight, tells it to you in stories. So I really like that book. It's Crushing It in Apartments by Brian Murray. So Jeff, does your investor serve as your bank or is it a partnership where you split profits? So the investors that I raise money from, I do it through a syndication. So essentially what happens is they're my partners. They're not my bank. They're my partners and we split equity 70-30. So I give them 70% of the equity and I raise the down payment. So I get, let's say a 70% loan, LTV loan on my property. I'll raise the 30% from investors. And then we'll split the profits from the deal 70-30 and the cash flow from the deal 70-30 as well. So that's kind of how I do it with investors. It's called a syndication, and specifically it's a Regulation D 506B as in Bravo syndication. So that's a whole different topic, and I believe that's what next week's webinar is how to set up a syndication, all of the back end of it, and also just kind of understanding the basics too as to how do you raise money for this kind of stuff? How do you do it at 20 years old? And yeah, is it really that complicated? And the answer is it's not that complicated. So Tim, what was your biggest issue raising capital for your first deal? Man, Tim's just asking awesome questions. I appreciate you, Tim. So another great question. The biggest issue that I had was I actually had someone 1031 into my first deal. So I had to set up a tenant in common agreement, and I had no idea that even existed at the time, which is because most people think you can't 1031 into a syndication because you're buying shares in an LLC. So they're like, well, how do I sell real estate and buy shares in an LLC and not pay taxes? You would obviously pay taxes. But the thing is, you don't buy shares in the LLC. You are a tenant in common with that LLC on the deed of the property, and then you can actually transfer and not pay taxes. So that was something I had to figure out and never knew about, and I had to do it with like 3 weeks to go. So that was, again, like you try to be prepared, you try to know everything, and then stuff like that pops up, and you just have to make it happen. So yeah, like you just kind of got to jump off the cliff and give it your best shot, and end up working out great. So, all things are fine. So Johnson, he asks, do I need to be an accredited investor to invest in a syndication? So no, you actually don't need to be accredited. If you do a 506B, as in boy or a Bravo, that's what I do. Essentially what happens is I can allow 35 accredited investors to my to my investment, but I can also allow an unlimited amount of people who are sophisticated. And sophisticated just means that you are identifying that you understand what real estate is and that you know what you're talking about, kind of thing. And it's the same process, but I can accept non-accredited. And for anyone who doesn't know what accredited is, being accredited means you have a more than a $1 million net worth, not including your primary residence. And you also make 200 grand a year if you're a single person, or 300 a year if you were married and you file jointly. So that's what accredited is. And it's the SEC's way of saying, like, if you're this wealthy, then hopefully you know what. Rodney, what do you mean by the other way around? Please clarify. But yeah, basically what happens is the SEC is trying to make sure that if you have money, then you would hopefully understand your risk. And that's kind of 35 sophisticated. I believe. No, yeah, you're correct. It is 35 sophisticated. I appreciate you, Rodney. Definitely keeping me. Is that actually true? I don't know. We'll have to see. Either way, I can accept non-accredited through 506B as in Bravo, which is a good situation. So we have Douglas Wilson here. From the perspective of the property management to the scale of repairs, etc., is there a big difference between owning a 5-unit and a 100-plus multi-unit family? So as far as scale and repairs, absolutely, yeah. So the scale really starts to make a huge difference around 50 units. And the big thing with that is, essentially with a 5-unit, think about it, right? You're only making so much income from, let's say you're making $100 per unit. So you're making $500 a month. You can't really have extra profit there to be paying someone to be on site 7 days a week. With a 5-unit, you'll probably have someone on site probably 3 to 5 days a week, or 3 to 4 days a week. And they're probably going to be more single family oriented, which means they're going to be thinking about it through the residential lens and not the commercial lens. And they're not going to be as professional. They're not going to understand the NOI valuation. And it's going to be overall a very different layout than the 100-plus unit, where I can have a full-time professional management company who has, like, let's say 2,000 units in the market that they manage. And all I have to do is, sit back 1 hour a week, have a call with them, and we're going to have cloud-based accounting. We're going to have everything kind of dialed in, and they're going to be a professional company that understands what they're doing. So we have Alfred Vita. Hello, Kyle. What are your typical returns? Why choose your group over other syndication? So I'm actually not advertising my group right now. We don't have any deals open for things that I mentioned about, lending requirements and coronavirus and things of that nature. So I'm not, I'm not here to pitch at all. Like, this is free value. I'm not trying to incentivize anyone here to invest with us at the moment. That's not, what this is about. The typical returns on my syndications, with all that being said, are essentially somewhere around 15% IRR is what we're looking for. And we're looking for around a 2.0 equity multiple. So that's essentially meaning that we're going to double your equity in the hold period. So if we have a 5-year hold, we're hoping to take you from 100,000 year 1 to 200,000 in year 5. And that's the ideal there. But again, we don't have any deals out because of coronavirus and some other lending requirements. And yeah, I'm not trying to soft pitch, but I do appreciate the question, Alfred. Thank you so much. So Miguel, how many doors do you have, sir? I have 119 doors. And yeah, and you're 15. I'm just stoked you're here. So continue to ask questions, man. That's so cool. So Jeff, did you plan on using a government issued loan like Fannie Freddie? Do I plan? Yes, I have used Fannie Freddie, and that's what I typically use, because as in the presentation, we talked about non-recourse. And so non-recourse is pretty much exclusive to those government loans, unless you're doing a CMBS loan. And so CMBS is a commercial mortgage-backed security, and they are going to have some serious yield maintenance and longer terms as well. So what that means is you can't get out prepayment penalty-wise early. Whereas Fannie and Freddie is kind of the premier best loan that you can get. So that's what I go for personally. And some of the requirements on that is like you have to have 90% occupancy, and it's a little bit stringent, but if you can get one, it's really ideal. So Brandon says, with anything above 50 units, are you hiring a property manager and a full-time leasing agent? So it depends on the situation. Typically, it depends on the situation in the market. Ideally, yes, because you can give a leasing agent a lot of bonus. Like, that's a typical way to pay them and have less payroll if you can't afford the scale. So you can put them on a bonus structure and pay them a little bit more per lease or something of that nature. But ideally, 50 units, you should be able to get that leasing agent in there as well. But also, it does depend on your market. Some markets have like very low rent, and maybe you couldn't make it happen in those markets. But like in Austin, for example, you might be able to make that happen. So Tim, with your experience from today, what would you have known as you started this syndication in real estate? What helped you the most? I would have just said, like, honestly, just continue to educate yourself on the lingo. being first, because for like 6 months in this industry, I used all the wrong lingo, and I kind of looked dumb for like 6 months, and I didn't know, right? And then you eventually learn the lingo, and you look back and you're like, oh, I said all those things in public, and I totally used the wrong stuff. I bet everyone thought I was so dumb in those conversations. But basically, yeah, so it really just comes down to educating yourself on the lingo so that you can speak to people, because the relationship, it comes down to relationships in real estate. It's more of a relationship business. So you have to know what to say. You can't just kind of come in and wing it. There's a lot of, the lingo in real estate is very calculated. People put it in place so that they could kind of like have a barrier of entry. The only real barrier in real estate is not anything to do with, background or qualifications. Like, I'm a college dropout, I'm 20. The barrier of entry is the lingo. Is if you know the speak, then you're in. If you don't know the speak, you're not in. That's kind of the thing there. So go-getters are given grace. Yeah, exactly. Just go have it. Yeah, that's another great question there, Rod. A great answer there, Rodney. Like, just go for it, right? Just jump off the cliff, because you're not going to know anything anyways. Like, I tried my best to be prepared, but we still had people 1031 into my syndication, and I didn't know, how to do that at the time, but I figured it out on the fly, did the tenant in common. So you just kind of got to go. You're never going to know everything you need to know. It's impossible. So Jeff, how is tenant security deposits handled when ownership changes? So typically those are going to be held in an escrow, and you're going to make sure those escrow accounts transfer over at closing. That's a big part of the due diligence checklist, is making sure that happens. But yeah, those security deposits are inherited, and yeah, they should have been kept in an escrow account separate from the bank account the whole time, because security deposits are not income. They're actually supposed to be held in escrow the whole time. You can't claim them as income. So that should be a pretty decently easy transfer, but you still want to make sure that happens, and that's on your due diligence checklist. So that's what happens to those security deposits. So Miguel, how do you pay your team members like bankers, real estate brokers, tax advisors, etc.? Do you pay them with a salary? No. So they're typically paid on different kinds of fees. So let's say banker, he's going to get a big old loan origination fee, and that's going to be somewhere around 1% of the loan. So that he's going to be well taken care of. Don't worry about him. And then the real estate broker as well is going to get a fee on the sale. So again, don't worry about that guy. The tax advisor and things of that nature. At times you'll have to pay hourly for a tax advisor, which can be kind of brutal. But again, they're saving you, as I showed you in the diagram, like a cost segregation attorney is going to save you. He's going to double your return. I mean, he's going to double your tax write-off every year. So he's taking you from $36,000 write-off a year to 72. So you can afford to pay that guy the 10 grand that it takes to do a cost seg study. So typically these people are definitely worth their value. And you don't really have to worry about the whole, how do I pay them and all that good stuff. And a lot of them do take fees. So that's another good situation. Man, we've been having some good questions flying in here. I'm out of breath. I need to drink some water. So cool. We still got a decent amount of people in here, honestly. So if you have questions, just keep firing them off. I guess we'll try to go, through 8 o'clock if we can. And I appreciate the questions. We got a lot of good ones from Tim, Brandon, Alfred, Douglas. We got Rodney in here. We got Miguel, Jeff. Appreciate you guys a lot. So just keep asking those questions to see that we still have a decent amount of people in here. So for sure, just continue to ask. I'd love to help out as much as I can. What is your primary trigger to qualify a potential investment? Gross rent margin or GRM or cap rate? So basically, I try not to focus on any single metric in its entirety, because there's a law called Goodhart's law, and I'm probably going to butcher it here, but essentially what it says is when the metric ceases to be a metric and starts being the target, it's no longer a good metric. So you don't want to have a metric become the target. That's like immediately means it's a bad metric. So what I'll do is I'll look at everything all encompassing, and I'll also look at a lot of different things like, what is the actual area situation going to allow me to do as far as raising income? Like, those are subjective questions that I don't think enough people ask. But as far as like a single metric that I would advise you to look at, Chris, would be something like a debt service coverage ratio, just so that you're capping your downside, and maybe even like a break-even occupancy, which is both things that are allowed on my calculator. So you're able to see how much what's the buffer between what I have and what I can pay the bank, like what I have to pay the bank and what I'm making in NOI. That's the DSCR. So you kind of want to know your worst case, and all of your best case metrics are going to take care of themselves, like IRR, cash on cash return, and things of that nature. And also the downside of the cap rate being the focus is that people think that cap rate, low cap means bad, right? Like the low cap typically means bad to most people, but it's actually not true, because cap rate is a value of risk and value. So let's think about buying a bicycle, right? If I go to a Target and I try to buy a bike, I'm going to be able to find a very cheap bike in there, which would mean in the analogy, that would be a high cap rate bike. The thing is, that bike's going to break in about a year. Like, yeah, I get to save it. I get to buy the bike for $100, but I didn't have to buy the $1,000 bike at the bike shop. but it's going to break in a year. And so there's a risk associated with that. So the cap rate is a metric of value and risk. Don't forget the risk part. So if you're paying for a super high cap and you're like, oh, I only buy 10 caps, well, it's like, well, then you may be buying a property with a lot more risk, because a 3 cap would be like a San Diego beachfront property. And obviously there's a lot of intrinsic value to being beachfront in San Diego. That value isn't going to go anywhere because everyone always wants to live on the beach in San Diego. So that low cap is going to stay low cap. And then you can raise NOI on a low cap. And if you take a number like 100,000 and you divide it by 0.03, it's going to be a lot bigger of a number than if you divide it by zero point 0.1 being a 10 cap. Or, so the lower the cap, the more value you can add. As long as that cap stays low, then there's different strategies. So I don't focus on cap rate too much. And I'd advise you to start kind of opening your mind with the cap rate if you're not already, and just start to look at what factors into it at all. So Gregory, do you look for a minimum equity multiple when underwriting? So again, it depends on a lot of the returns. So if the equity multiple is, let's say, lower than I want it to be, but everything else is solid, then I'm going to still do the deal. But if the equity multiple is, let's say, really high and then everything else is horrible, well, then I'm not going to do the deal either. Ideally, I want a 2.0 equity multiple because I would really like to double everyone's money. That would make me, really excited. And I think it would make everyone really excited. It's tangible and it's easy to understand. Like, hey, you gave me 100 grand, you got 200 grand, you doubled your money. That's pretty awesome. So that's why I look for the 2.0 equity multiple. But again, I'm not like super married to that. If everything else looks amazing and as well as the market, then I'm going to be a little bit more, flexible there. So Tim, what is your minimum amount USD or US dollars for limited partners? How do you qualify them? Do you have a document? Do you document this education anyway? So that's a good question. So basically, my minimum requirement is 50,000 for my LPs, and the way that you qualify them is you have to have a pre-existing relationship in my kind of syndication, the 506B as in Bravo. And the way I do that is if I have an email with you and I have 2 phone calls and we've met in person and we texted about that meeting that we were going to, and then I've also, or like we've had Zoom calls, those are all, that's the trail, right? Like we have a relationship after a couple of those. It's hard to judge. There's no like set number, like 3 and you're good. There's no real set number, but you have to think about it. Like if you get taken to court, is there going to be like the more, the easier it is for you to prove. Like if the guy goes, I didn't even know him, and you have 7 phone calls with me and 10 emails and 4 in-person meetings and you say you didn't know me, that's going to be a hard thing for you to argue. But if we only have 1 email, then maybe you can make that argument and maybe I lose. So that's kind of what you have to think about as far as pre-existing relationship. Like how much of a paper trail and honestly, how well do you know this person? You're supposed to know them on a level to where you understand their financial situation personally. That's kind of the metric. So I need to kind of know what you make, what assets you have. Like we need to know each other at that level. It can't just be like a surface level relationship there. So I hope that answers that question. We have Brandon. How many deals are you analyzing a week right now? And do you personally underwrite them or do you have a partner underwriting? So that's a good question. Right now I'm trying to do around 5 a week. And I'm looking to actually get a partner to start doing some of that. And we're looking for some more experienced guy in Dallas right now that we're talking to. So hopefully I can get him as an analyst and I can take that off my plate. But right now, I'm just looking at deals so I can understand when the market's going to start to soften. I personally haven't been sent any deals where sellers are looking for a lower price because the situation right now with the seller market is they haven't had any occupancy issues because of the stimulus checks and also the full effect of the coronavirus, shutdown hasn't fully been felt on them. So their argument is like, hey, I'm still making the same money I was making in January. Why would I sell it for less? And that's kind of a decent argument. So I'm like, I don't know. I can't really tell you anything. But then the bank, on the other hand, is saying, hey man, I'm not giving you a loan unless you have 12 months of reserves. So there's kind of this stalemate there, and one of them is going to have to give. And whenever that happens, then I want to know, and that's why I'm underwriting 5 deals a week right now. But yeah, I would just suggest to start around 3 to 5. It gives you a good understanding. But that's just something to keep your eye on: is what are those lending requirements, and what are the prices? Are they softening at all? Can you talk to some brokers and ask? And I haven't seen any softening, so that's kind of a situation there, but we'll see what happens later in the year and into 2021. So Vinky, when did you start? Did you have a bad deal so far? So I'm 2 for 2 right now as far as good deals. I'm only 21, so I don't want to say I'm never going to have a bad deal. I'm sure in the next, I plan on doing real estate till I pass away, right? So I'm sure eventually somewhere in there'll be a bad deal, but so far they've been pretty much down the fairway. I bought them really safe and overly safe because, like, if you do a bad deal when you're 20, you look like a moron, and everyone invested with you looks like a moron. But if you do a good deal when you're 20, you look like pretty awesome. So my whole thing was, how can I cap my downside? Buy very conservatively and make sure that everything stays right down the middle of the fairway. And that's kind of what I did. So I'm sure eventually, as my comfortability raises and I become older and have a bigger list, I may try to do things with more upside and more downside as well. But right now I'm thinking, how can we be right down the middle of the fairway? I'm gonna lay up and hit the 4-iron that I know I can hit on a laser and not take out the driver, leave it in the bag kind of thing. It's a little bit heavy on the golf analogy, so I apologize, but yeah, that's kind of what my thinking is right now. So Jeff, I always thought leasing agents were part of a property management team. If not, how do you go about finding and evaluating one? So yes, they typically are, but you can do different kinds of promotions where you would have an outside property leasing agent come on. That's typically for bigger properties, but yeah, typically you can figure out a way to bring them in from the actual property management company, which is, I would say more or less typical, which is a good situation. And typically they'll be involved in the fees, but you still may have to pay them a bonus as well as them being paid from the fees and things of that nature. So that's something to consider. So what are the pros and cons? Again, that depends on your market, Jeff. So Miguel, what are the pros and cons of commercial real estate? Pros would be the non-recourse nature of the loans, the fact that the value comes from profit and not comps, so you control the value. The other thing would be economies of scale, so you actually have free time. Because let's say you own a single family home, you go out and you buy a house, you save up all your money, you go buy a house. Well, guess what? The toilet breaks, you're fixing the toilet. Or the guy locks himself out at 2 a.m., he's your tenant. You got to drive to the property, let the guy in. You know what I mean? Like, it's now a job. You don't have the freedom. The whole point for me dropping out of school and doing the whole real estate thing was so that I could do what I wanted, when I wanted, with who I wanted, where I wanted. Like, that's the whole thing for me, right? I want to enjoy life to the fullest, live with the people that I love to live with, my parents, my family, my brother. I want to be able to spend time with those individuals and not have to, be going to a job or being pulled in all these different directions. So that's kind of what commercial gives you. It gives you that freedom to really enjoy your life. So what do you think about big deals with like 500 apartments? So, I mean, yeah, if you can afford them and you can make them happen, absolutely. I would just mean more scale. It might mean a little bit more things that could potentially go wrong across more buildings. But, if you have the team to put that down and you have the capital that you can raise to do that, the more the merrier almost, honestly. Another great question. So we have still a decent amount of people in here. We're a little bit past 8. I'm good to keep going. When the attendance drops a little bit lower, then we can maybe think about it, but we still have a lot of people in here. So yeah, feel free to keep asking questions. So Brandon, when underwriting, what are some expenses that might be a big red flag for you and harder to lower? Huge red flags for me are typically been payroll. I've seen payroll be a huge red flag for a lot of people. And typically, they'll have people making quite a bit of money. I have a deal that we walked through last week where the payroll was around 90,000, and on my first deal, the payroll was actually around 90,000 for a guy, and he was a cousin, right? And they were overpaying him, and we cut it down to 35,000 day one, which was nice. The other thing would be sometimes they overemploy, so they'll have like a maintenance tech and a property manager and someone else. Maybe they'll have that third guy that you could maybe do without, and pay someone so instead of paying 3 people 30,000 or 3 people 35,000, you pay like 2 people 40,000. So you give them a little bit of a bump, you give them slightly more responsibility, and you save some money there. So that's another good situation. The other one I would say would be utilities. So if people aren't billing back for utilities, that's a huge red flag, something I look at. What else would be a big one? Someone who's not charging like some sort of fees or other income, that's typically a sign that it's not a professional owner, because professional owners are always looking for ways to do other income and make that better, and also charge move-in fees, pet fees, and ways to kind of boost the income 5 to 10%, which can make a huge difference. So I would look at the other income category. I would look at RUBS and utilities, and I would also look at payroll for sure. And you may have some other things on repair and maintenance, but that's typically justified depending upon them, getting everything ready for sale, or, those can vary a little bit. So I'm typically just looking at those main ones right there. But it's always good to know your market average. So in Austin, the market average for repair and maintenance is $550 a door, and payroll is $1,000 a door. So if I see that my payroll expense is like not 15,000, that'd be ridiculous, but like $2,000 a door, then I know that they're probably overpaying people, and then I can cut that down to $1,000 a door. So that varies in every market, but it's important to know those averages by asking brokers and talking to investors in the market, so that you have a benchmark to see, hey, should this be a red flag? Because you have no grounds to understand if it's a red flag until you have a benchmark in which to set it against. So that's typically just probably, I would say, your first order of business would be to understand all those averages. Cool. So let's keep asking some questions if you guys have them. Okay. I think this. What is your criteria for finding brokers? Is there a particular platform you use? So that's a great question, Jeff. I will go into that right now. And also, if you want even more on this, Jeff, I did a whole webinar on this last week that's on YouTube. But I'll go into this right now, which is basically what I do is I'll try to go to LoopNet, and not for what you think, right? I'm not going to LoopNet for the deals, because the deals it's the graveyard, right? There's no good deals on LoopNet. But the thing that I will do is every single broker has an account on LoopNet pretty much in the country. So I'll go to the LoopNet broker directory. So if you type in loopnet.com/broker directory, you'll go to a page where you can see all of the brokers in that area, and you can search by city and by asset class. And then from there, you go to their profile on LoopNet, and you go to their personal website. And on their personal website, you'll actually be able to see their property listings that are off LoopNet. And those are going to be typically not always great deals, but better than LoopNet, and they'll actually have deals on there. Sometimes there's not even any deals on LoopNet, period. But if you can underwrite one of their deals that they have listed and give them some feedback, and that's your intro email. So your intro email is not, hey, I'm Jeff, I want to buy a multifamily. That's basic. Everyone gets that email. But if you say, hey, I'm Jeff, I just looked at the 104 unit on your website, and I noticed that, it looks like you could raise the rents $50, and it also looks like it's right in the area of town that I'm looking in. I'd love to talk more about it with you. That's a way more enticing email for that guy, because you sound like a buyer instead of a tire kicker where you're like, hey, I'm just here looking for multifamily. You know what I mean? Like, that's what everyone sends. So hopefully if you can follow that flow, then you'll be able to actually get some actual response from the broker, and you won't just get left on red and put in a spam box. So Miguel, where do you take the knowledge? Where did you take the knowledge for did your first deal? I apologize for that. The knowledge for did your first deal, and how much time did you take to your first deal? So I think you're asking, like, where did I get the knowledge to do the first deal, and how much time did it take me? So I got the knowledge a lot from just reading and being absolutely obsessed about it. So the thing is, like, you should realize this right now. It's like, you can take this multifamily thing and change your entire family's life, your family tree, your kids' kids, if you just do this one thing right? Simplify your life, right? If you figure out multifamily from a financial side, you can make sure that your parents retire comfortably. You can make sure that, your kids are able to get all the access to education that they need. And you can make sure that your whole entire family is better off, and that you don't have to work a job till you're 65 and then potentially die and your pension not even be given to you. Or retire, or try to retire and your pension not be given to you, and then you die. Or die before you're 65 and you worked all the time to get to 65 and you die. Like, you know what I mean? That's horrible. So I was just very motivated to learn this, and I did nothing but learn it for, a decent amount of time, just day and night, honestly. And it took me so I got really serious about multifamily and commercial in January of 2019, and I closed my first deal in June of 2019. So it took me about 6 months from like fully deciding commercial multifamily is the way, and then 6 months later I was able to do that 107 unit deal in Louisville. So that's a somewhat atypical, but if you work super hard, I think that you can do it. So what books did I read? I actually have a resource guide on my website. I'll give you like the key ones, but I highly recommend you just go to my website, Marcotte.com, and you download the guide. Basically, it's called the Newbie Investor Guide. It has all of the books I've ever read and all the podcasts I've ever read, and study questions for each book or each section on the thing. So it's a pretty good resource for that kind of question. Yeah. So here's the link. Adam just threw it in there. Like, you didn't take any online courses. So I didn't take any online courses. No, I joined a mentorship program later on just to get some more specific information. But I didn't take any online courses at the moment. There's kind of a big lack of online courses in the multifamily space right now, and that's why we're trying to come out with one eventually here in the later part of the year. So I'm trying to fill that gap where there's no real courses, because right now all there is in multifamily is like super expensive mentorship programs or nothing. There's no like affordable courses that people can take that are, like, let's say your age, 15. Like, how are you going to afford a $50,000 program or some crazy thing like that, or like $10,000 program? So let's try to get something that's more affordable for people who are in their teens and 20s and early 30s and young people who want to get into this. So that's kind of what we're trying to do. But as far as books, yeah, definitely go to my website and download that. The best book I probably read on commercial multifamily would probably be, I think, Crushing It in Apartments by Brian Murray would be the best one to start with. So Jeff, how often should an owner physically check in on their property? That's a great question. It depends on your risk. For me, I like to do I like to do it quarterly, and I like to do a secret check. So I won't tell them I'm coming because I want to know how the deal's actually going. And what I'll check when I'm there is, number one, I want to check all the vacant units and I want to make sure that they're actually vacant. So I'll knock on the door and see if someone lives there or not. And because if there's someone living there but they're marked vacant, that probably means the property management company is taking cash under the table, and that person is paying the management company directly, and that's kind of their little workaround. So I come secretly and I knock on the vacant properties, and then I also will see and check all the repairs. So if I've been quoted for like $15,000 for a new sign or something, and I go to the property and there's no new sign, that means they didn't do the repair and they took the money. So like I'm trying to come and see those kind of things that I don't want to give them heads up so that I can kind of see that. And then if you didn't take the online course, this other grant cardone program for 10 grand, yeah. So that's it's like 10 grand. Peter Harris, I don't know who Peter Harris is, so I can't recommend him, but yeah, there's not too many good courses in my opinion out there, and that's kind of what we're trying to do is give an affordable course to 20-year-olds, but we haven't come out with it yet. It should be out in first week of August, so I'll let you know about that at that point. But right now, yeah, this is just kind of the issue in multifamily, but we're gonna hopefully fix that, so that should be fun. So 8:10. If you guys have some more questions, I guess we'll do this for a little bit longer. It seems like we still got a decent amount of people in here, so if you have the questions, ask them. Feel free. I'm still here for sure. We still have a surprising amount of people in here, so I'm assuming that you guys have some questions. So I'm just gonna stick around for a little bit more. Cool. Thanks, Kyle. Did a great job. Thanks, Rodney. Yeah, I appreciate you, man. You kept me in check, and I appreciate that, man. It's not always easy to get the correct stuff out on the spot, but I appreciate you helping me out with the some of the more technical stuff. So I appreciate you, man. Thanks, Kyle. Been on every webinar you hosted. Yeah, you have, Brandon. I appreciate you, man, dude. You're the guy. You're the man. I appreciate you so much for showing up. Kyle, thank you for today and great info. DM me on LinkedIn, Rodney. Yeah, I'd love to connect, Rodney. Appreciate you being here. So Brandon, Brandon, I appreciate you, man. Alfred, good night. Look forward to our 30-minute call. Yeah, thank you for booking it. That's awesome. If anyone else hasn't booked it, feel free to book that. We'll also have an email going out tomorrow with all the stuff. So if you missed it here in the chat box, you'll get it tomorrow. So that's don't freak out. You don't rapidly scroll to back up there. We'll send it an email, and it'll all be good. So yeah, I appreciate you guys so much for showing up. It looks like people are starting to sign off now. So we will wrap this up. I appreciate you guys so much for coming, and we have this next week as well. So that should be another good opportunity. Let me, how do I end this thing? Oh, cool. Here, end meeting. Awesome. Thank you guys so much. See you guys next week.